Okay, so I'm going to go back to the PowerPoint. And now we're going to switch gears and talk about, well, what if we are publicly traded? If we're publicly traded, then we can't use the direct write-off method. So the allowance method. What we do here is at the end of the year, as an adjusting entry, we are going to debit bad debt expense still. So it's still a bad debt expense. We're still using that account. But instead of writing off specific accounts receivables, we are going to estimate at the end of the year the total amount we think is uncollectible from
let's
all.
say you have 5 accounts, is all of them?
Well, what we would do, say we had 5 accounts that owed balances at the end of the year.
That's all in your accounts receivable, right?
Mm-hmm.
Yeah, all that.
Yes, yeah, we would add up all the accounts that we have that's owed to us at the end of the year. And say, well, like, let's look at this example. Well, they don't, yeah. They have, Xtone has an accounts receivable balance of $200,000. So at the end of the year, $200,000 is owed to us. That could be from last week or from like January 1st or even from last year. Accounts receivable is a permanent account. Do you remember talking about permanent versus temporary accounts? Permanent accounts carry balances from year to year. Cash, accounts receivable, like all of your assets, all of your liabilities, all of those carry balances year to year. So of that $200,000 that's in accounts receivable, that could be accounts receivable sales I've made this year, or it can even be from last year, technically. Hopefully not, but it could be. Because that balance just keeps changing daily, really. Could change daily. So at the end of the year, we have $200,000 owed to us. So we're going to learn later in the chapter how to determine or estimate what's uncollectible. But in this case, they just tell us Xtone estimates that a total of $30,000 of that will be uncollectible. So they're going to use different methods. So the most common is like an aging of receivables, which we'll do like a schedule. And you've probably seen this. You know, even if you get a statement, like bank, like I think of like a medical bill, and it shows you at the bottom what portion is due in like 1 to 30 days, what's past due. You know, all of that. That's what the companies will do. The older a debt gets, the less chance we have of collecting on it. Makes sense, right? If they haven't paid in 90 days and then they haven't paid in 150 days, they're probably not going to pay us. So there's different ways of estimating that, and we're going to learn that in a little bit. But right now, all we know is they have $200,000 owed to them at the end of the year, and they estimate, it's a good estimate, that $30,000 of that is uncollectible. So again, this is an estimate. It's not a guess per se, but it's still an estimate. So we go off of historical data, we go off of some type of formula to figure out how much we think is going to be uncollectible. So we estimate that. And so instead of writing off direct accounts, we're going to write it all off to allowance for doubtful accounts. So bad debt expense gets debited. This is an adjusting entry. Notice the date, December 31st. So we do this at the end of the year as an adjusting entry. Bad debt expense gets debited and allowance for doubtful accounts gets credited. Okay? So what that means is we anticipate of the $200,000 that we're not going to receive $300,000 or that doesn't add up, $30,000. That would be really bad if we were receiving less than was even owed to us. So what that basically means then, and we'll see this in the PowerPoint, but just to kind of explain it to you, when we're reporting accounts receivable on our balance sheet now, we're going to say accounts receivable minus allowance for doubtful accounts. So we're going to report on our balance sheet what we think we actually will receive, $200,000 minus the $30,000. So it'll be a more accurate depiction of our financial status. That bad debt expense is coming out of our sales. You know, we're going to subtract it in our income statement. So our net income is going to be lower. Our current assets are going to be lower. And that's what we want. We want it to be as close as possible to what we think we'll actually receive. Okay? But that is just an estimate. So at the end of the year, we always do an adjusting entry. If we are a publicly traded corporation, it's always a debit to bad debt expense and a credit to allowance for doubtful accounts. Okay? That's our adjusting entry, the debit and the credit. The amount will change. Okay? Any questions on that so far? Okay. Oh, I didn't talk about, that's one thing. So allowance for doubtful accounts is what we call a contra asset account. Does anyone remember what contra means?
Opposite.
Opposite, very good. So whereas normally accounts receivable has a debit balance, the normal balance for allowance for doubtful accounts will be a credit. Okay, it's kind of like your depreciation. Remember how we didn't, when you were logging depreciation on equipment, you debited depreciation expense and credited accumulated depreciation instead of like the equipment itself. That was a contra asset account. So allowance for doubtful accounts is a contra asset, more specifically a contra accounts receivable account. So it just increases on the credit side. So basically all that means is it's reducing our accounts receivable, but we're keeping track of that reduction separately, okay? So we're reducing our total accounts receivable, but we're keeping track of it separately. Does that make sense? Again, record keeping. Talked about that. So again, I kind of talked about that, but this is here on the slide. So what that means on our balance sheet is we're going to have accounts receivable minus that allowance for doubtful accounts. So that's going to be our net realizable value. So the net, if you see the term net accounts receivable, that means they've subtracted out that allowance for doubtful accounts. So that's what we think we're actually going to receive. So we did that journal entry at the end of last year. Then we move into the next year. Under the allowance method, we will still write off customers. We don't want to keep them on our books indefinitely, it'll be 20 years later and we still show that DL Ross owes us 42. We will still write off accounts. Okay, we still want to look at customers and say this customer's not going to pay, they fit this profile, we're still going to write them off. It's just we can't do a direct write-off. Okay. So what we're going to do is we take it out of that allowance. So we've said $30,000 is estimated what we're not going to collect. Now as we go through the next year, we say, oh, customer number one, well, we're writing off his account. So that comes out of that $30,000, and we just keep doing that. So as we write off, we're going to debit allowance for doubtful accounts. So that $30,000 gets directly written off to other customers, and it reduces that allowance. Okay, so that's where it gets a little tricky. Allowance for doubtful accounts and doing these estimates can get a little tricky. So we're going to step through it pretty slowly because I don't want to get you too confused. Okay, so under the allowance method, we now deem that John Parker is not going to pay. So on January 21st of this new year, we already estimated and wrote off $30,000 to allowance for doubtful accounts. John Parker's account of $6,000 is written off, okay? And so just to kind of visualize that, and I don't think it does it here, no. Okay. So we did on the 31st, well, let me write it as a big, sorry, I shouldn't do that. Just mirror this. So allowance for doubtful accounts, again, is a contra asset account. So it increases on the credit side. So when we made that adjusting entry, bad debt expense got debited and allowance for doubtful accounts got credited. Okay. So now when we do this journal entry, and this was December 31st, we'll say of 19, okay? In this journal entry, we're debiting. Okay. So that's affecting my allowance for doubtful accounts, isn't it? So now I'm saying of all of what I estimated, 30,000 total, well, 6,000 of that is John Parker's account. So it's not affecting what we call our net realizable accounts receivable. Okay, and I'll show you why. Because your total accounts receivable your total accounts receivable as of December 31st was what, 200,000. Well, you credited accounts receivable right here. Okay. So we're really just moving it from allowance from doubtful accounts and taking it out of accounts receivable. So at the end, just to kind of visualize that more, on 12/31, we took accounts receivable minus the allowance, which was what? It was 200,000 minus 30,000. So my net was 170. Well, after this journal entry on the 21st, my accounts receivable is now 200,000 minus 6,000, right? The balance.
So is that us writing more money off for him?
No, we're just saying of the total we wrote off, 6,000 of that was John Parker. So it's not changing the total. So now I have accounts receivable is 194 and allowance for doubtful accounts is 24. Okay. So now I have accounts receivable minus my allowance. I have 194,000 minus 24,000. My net stays the same. Net. And that's net accounts receivable. Okay, I'll move out of your way. So what I've done is, I've just said total 30,000 is uncollectible out of this whole 200,000. That's what I originally said, right? So my net accounts receivable that I thought I would receive is 170,000. When I write off an account under the allowance method, what I'm saying is, of that 30,000, 6,000 is John Parker. So I debit allowance for doubtful accounts, which brings that balance down to 24,000, credit minus debit. And I credit accounts receivable, the 6,000 that I'm directly identifying as John Parker. So accounts receivable is now 194,000. But it doesn't change how much I think I'm going to receive total. My net accounts receivable is still 170. Okay, so it's not changing how much I anticipate I'm going to write off. So that's a big concept. If you can understand that, it'll make the rest of the process a little bit easier. So are there any questions on that? Okay. So this gets all wordy, right? The slides, I hate them when they're so wordy. But again, the tricky part is allowance for doubtful accounts has a normal credit balance, as we see right here. If we estimate pretty correctly, what we're going to do throughout the whole year, January to December, is we're going to continue to identify accounts, direct accounts that are uncollectible. So we'll keep debiting allowance for doubtful accounts. So what happens at the end of the year, allowance for doubtful accounts is a tricky little account. It can have a debit balance or a credit balance before we do adjustments. So that's where it gets fun. So allowance for doubtful accounts, if we underestimated, and we wrote off less than we actually, we end up writing off more throughout the year than what we estimated. So if we had, 5 more accounts and the total over here ended up being like 32,000, we would then have a debit balance, right? That's going to change how we do our adjusting entry at the end of the year. Okay, so when we do our adjusting entry at the end of the year, we will always have a credit balance and allowance for doubtful accounts after the adjusting entry. Throughout the next year, as we determine accounts specifically to write off, it could end up being a credit or a debit. Okay. So allowance for doubtful accounts will have an ending debit balance if we've written off more than the estimate. It will have a credit balance if we've written off less than the estimate. So obviously our goal would be that it would be 0 at the end, right? That we would write off exactly what we anticipated. But again, that's not real world. It could be either a debit or a credit balance. So we're going to look at examples on that and kind of play with that. But I really wanted you to understand, that's how that allowance for doubtful accounts works. So as we go through the year, we're doing actual. It's no longer an estimate. We're really writing off accounts. So at the end of the year, we could go back. Allowance for doubtful accounts could have a debit or a credit balance. And that's going to affect our adjusting. Okay. And that's what this slide is saying. Okay. Let's see. At this point, I think we can actually go do one more example before we get into the actual estimates and dealing with this and what, the really fun stuff. So let's pause right there and go back into your practice and go to the second one. Because let's just practice the simple part of the allowance method, okay? So in this case, we're going to look at a sale, and then we're going to look at a reinstatement, okay? So it says, journalize the following transactions in the accounts of Zippy Interiors Company, a restaurant supply company that uses the allowance method, okay? Well, again, May 24th is just another review. It's just another selling merchandise on account. So this is just like the first one. So we sold merchandise on account to Old Town Cafe. So what do I debit and credit for that sale?
Accounts receivable and sales.
Very good. I debit accounts receivable and credit sales for the $18,450. $18,450. And then on the 24th, well, it said the cost of goods sold was $11,000. So again, cost of goods sold gets debited. And inventory gets credited. We're using the allowance method, and it says on September 30th, we received $6,000 from Old Town Cafe and wrote off the remainder as uncollectible. This is similar to the last one we did, only the last one was direct write-off. So now we're using this method, okay, allowance for doubtful accounts. So we still need to receive the cash though, right? They did pay us $6,000. So cash still gets debited, $6,000. But now, just like I did here when we wrote off John Parker directly, I'm going to write off the remainder of that account, like the $12,450, by debiting allowance for doubtful accounts and crediting accounts receivable Old Town Cafe. Okay. So I debit allowance for doubtful accounts, $12,450, and I credit accounts receivable Old Town Cafe. So the difference between the direct write-off and the allowance method is we would normally, under direct write-off, we would have debited bad debt expense here, okay? But we already did that with our adjusting entry. So with allowance, we're going to debit allowance for doubtful accounts when we do a direct write-off. And we're going to credit accounts receivable. So what they're not showing us here was that end of the year adjusting entry. So, last year, December 31st, they wrote off $50,000, debited bad debt expense, and credited allowance for doubtful accounts.
Wouldn't accounts receivable be $18,450?
Oh, I'm sorry. You're right. Thank you. Good catch. Yeah, I'm just plugging along, right? I did that on purpose, totally. Yeah. Good catch. I totally did not do that on purpose. So yes, you're absolutely correct. We want to write off their account for the full amount, right? Because they paid us $6,000 and we wrote off the rest. So we closed their account the full balance. Okay. And then, like the previous one, on December 7th, we reinstated their account that had been written off. Okay. Well, it's really the same as what we did under direct. We're just doing reversing entry. Our reversing entry just changes because of our original entry. So what do you think, to reinstate, what do you think I'm going to debit?
Accounts receivable.
Accounts receivable, very good. For how much?
$12,450.
Perfect. And then what do we credit?
Allowance for doubtful.
Perfect. Allowance for doubtful accounts. So we are truly just reversing this right here. Okay. And then we collected on it. Well, collection is the same as always, right? We got cash, or we received cash. And then we credit accounts receivable for Old Town Cafe, $12,450. So the difference is, instead of using the bad debt expense account, we're using allowance for doubtful accounts. Okay. Otherwise, it's really the same structure. Any questions on that? Okay. Well, you can always use the check my work. Make sure that, you know, I got the numbers right. We got the numbers right. I should have asked you all. You would have told me the correct one. Okay. And then I'm going to go back into the PowerPoint. That's real quick.